Welcome everyone, and thank you for choosing to listen into the latest edition of the JMI monthly video update. Since we last spoke, there have been some pretty significant developments in financial markets, which have got some pretty clear implications for investment portfolios. We've worked our way through the US third quarter reporting season. We've had a flurry of central bank activity, and domestically, it feels like we're at a pretty critical juncture economically. So we've got to think about what does all this mean for local investors. Now, in our last update, I reflected on the weakness that we'd seen in some of the global markets in September, when the S&P 500 fell about 4.8% in US dollar terms. Well, October has really turned that on its head. That market bounced back just under 7%, 6.91% in October, so very strong performance. Now, if I look at the performance, say, of that US share market over the last 12 months, in New Zealand dollars terms, it's up 30% from last October, so a very strong period. And if I look at the global or world index, it's also up substantially, almost 25% in the last year. The Australian market, sort of similar numbers, 22%. But the New Zealand market, by comparison over the last 12 months, although it's still in positive territory, it's only up 8%. And if I look at the 2021 or the year to date, it's gone virtually nowhere. So a very flat performance for the year so far. So the New Zealand share market performance on a relative basis has actually been quite poor, but all the action though has been in the interest rate markets, and wholesale rates in New Zealand have risen substantially since we last spoke, with the benchmark 5-year rate lifting from, it was around 1.85% at the end of September. It's now at 2.6%. So that's really pushing up fixed rate mortgages, and that's as a result of much stronger than expected inflation numbers, growth and employment numbers. So the US market over the course of that October has really gained confidence from that third quarter US reporting season, because generally company results have been better than expected. And a key feature of that is that companies will be able to maintain and improve their margins. And to a degree, they needed to, because with the US indices, things like the S&P 500 and the Dow Jones all trading at all-time highs, that meant there was quite a lot of good news that was built into those market levels. But in general terms, company results delivered on those expectations. And I say a key point is that the ability of businesses to pass on rising costs. And that brings us to the topic of inflation. Now, this is a real global conversation now, but the magnitude and the context of that discussion is actually quite varied, and it segues us quite nicely into a discussion of central bank attitudes to inflation, because we've had this flurry of central bank activity. Now in Australia, if we look across the Tasman, the Reserve Bank of Australia is prepared to be patient. It wants to see how the inflation track develops. Now at the moment, the starting point for the Aussies is quite elevated, but it's not extreme. I mean, their preferred version of inflation has crept over 2%. It's crept over 2%, but it's nowhere near as high as we're seeing it in other places. So go to the US. Headline inflation in the US is stronger. Their consumer price index at 5.4%. But the Federal Reserve looks at another number. They look at a number called core personal expenditure. That's quite a bit lower at 3.6. And the thing is the Federal Reserve they're not convinced that these inflationary pressures will be persistent. So in both of those cases, there is a measured approach to reducing stimulus and eventually raising their respective cash rates. But then we talk about New Zealand, and some of the problems in New Zealand do seem to be a little bit more acute. The fiscal and monetary policy response in New Zealand to the pandemic was substantial. We saw large amounts of government spending. We saw a significant degree of monetary policy action, which saw our interest rates fall pretty much to zero. So we've seen a lot of asset price appreciation, things like housing. The thing with New Zealand, though, is that some of the global outcomes of COVID, things like supply chain disruption, capacity constraints, they're being felt very keenly in New Zealand because we're heavily dependent on imported products, and we're facing a pretty severe labour shortage because our borders are closed and we can't import the same degree of labour that we used to have. So it's generated a whiplash in inflation, and our inflation could get to, well, we're getting projections now that we could see inflation numbers of like 6%. So the central bank, the local banks increased the official cash rate, but the important thing for investors at the financial markets, they're pricing in quite a lot more. They see the official cash rate climbing to, well, almost to 3% by the end of 2023. So very much in New Zealand, we seem to be in the monetary policy fast lane. We're roaring along there, increasing interest rates, whereas other jurisdictions are taking a slightly slower and more measured approach. So it means we're facing a number of uncertainties, in locally. How strong is the bounce back in New Zealand, the economic bounce back going to be from these last two disrupted quarters? The third quarter, the fourth quarter, they're both going to be disrupted by all the lockdowns. Is that bounce back going to be waylaid by rising interest rates, by less disposable income, by labour shortage? And we're already seeing that possible influence of higher rates on share market performance in some sectors where the effect of those interest rates is making itself felt. So what does this mean for investment portfolios? Well, on balance, we think the returns for 2022 will be lower for global share markets than we've seen in the last 12 months. And the headwinds are gathering, but there's probably still quite a bit of runway before we start to feel those headwinds. Locally, interest rates have risen. Unfortunately, so has inflation. So the real return doesn't look a great deal better. But the nominal returns, the headline rates, they're moving towards levels where fixed interest investment will start to look more attractive than it has done for quite some time. So look, at some stage, we'll probably start thinking about maybe reducing share market exposure back a little bit, not quite there yet. But look, if you want to talk about your investment portfolio or investment options, then why don't you look us up on jmiwealth.co.nz or give us a call. We'd love to hear from you.